Everybody, happy Wednesday. We are coming to you live from Investing Education Academy. Myself and the co-founder of Investing Education Academy, Leon Noble. So today we're going to talk about this market. It has been up, down, left, right, um, at a standstill, just a free fall, a climb. I mean, you name it, it's been happening in this market. We have so many things happening globally and so many things happening also locally. So we're going to tell you, Leon's going to tell you why we chose this topic while I do some housekeeping.
Yeah, the topic today is basically we've said in the past how um okay, so let me take a step back. So we've been getting a lot of questions about, is it a good time to invest in this stock, that stock, ETFs. These are from people that are already invested and people that are new, that are not invested. In our view, typically is, I mean, Brent and I are huge fans of dollar cost averaging, right? And the reason that is, and just to take a step back, so what all dollar cost averaging is when you invest a certain amount of money at a roughly a set period, at a roughly a set period of time, either maybe once every week, once every month, maybe once every 2 months. There's some rhyme or reason the way you do it, right? So you may pay, let's just say once a month. Say you put $200 in the market once a month. We're big fans of that because there's no timing the market, right? So we just got a question from a member 2 days ago, asking about a particular stock, and he was asking, is it a good time to get in? And my point was to him was like, we never know that. Like, I've said this before. I hate when people ask me, and I'm not saying I hate when people ask me questions, but what I mean, wrong way to say it, wrong way to say it. We're trying to change people's perspectives on this, right? So when people ask me specifically, is this a good time to get in or buy XYZ? I have no idea if it's a good time to buy XYZ. Nobody does, right? So, but the question should be, the thought process should be, okay, XYZ stock is down 10%, right? The thought process should be now, because again, we don't know when it's going to bottom. We don't know when it's going to top. We have no idea. So trying to say, okay, I'm gonna wait for the bottom. Next, this thing shoots up 30%. You missed out. So what dollar cost averaging does is it lets you put a set amount of money in, like you said, every month, every week, whatever. But you do it if the market is up or if the market is down. And what happens over time, you get like an average price. So that's one thing. So that's one thing to think about is dollar cost averaging. It's very, very powerful. But another reason Brent and I are typically like, get in when you want. Like, don't think about this whole like, is now a good time. What we're going to cover today is that. So what we said in the past, that if you miss the 10 most profitable days in any stock, you basically miss all the gains for the year, right? So if you're wondering, Dan, should I get in today? Should I get in tomorrow? You put that out the window, because you have no idea if today, tomorrow, next week, next month is going to be one of those 10 biggest days. So we're always saying, look, if you want to get in the stock now, if you believe in the stock, because our thing is, look, just research the stock, make sure it has strong fundamentals, definitely not in this market, strong profits, years of profits, and then just get in, right? Just put some money where it doesn't have to be all of it. You can be, 2, 3, 4%, whatever, but slowly over time build it up. Because again, you don't know, and I don't know, Brent doesn't know, nobody knows when is a good time to get in. It's the best time to get in is when you can afford to get in at that moment. So I say all that to say today we're going to cover a big point. Another reason we say that is because the 10, they're on average, the 10 biggest days for any stock or the market in general are the days when all the profits are made. So we don't know that. Nobody knows that. So we're big proponents of just getting in when you can and then scaling over time.
Yep. And Leon, do you want to go into the Fed announcement first, or do you want me to jump in?
No, I'll do that last.
Okay. So you all always hear us talking about what Leon just said, so I won't repeat it all. But the one thing you don't hear is what other people are saying. So we actually pulled the article from Motley Fool, and we're going to kind of go through it today. So this article came out from Dan Kaplinger from Motley Fool, February the 8th, and it's missing the best days in the market will cost you. That's the title of the article. So in it, I just went in and highlighted some things just to make this easy for anybody who's following along. If you're listening to the podcast, I'm going to read what we're showing right now, so don't worry about it. You can follow along with everybody else. The first statement in the paragraph says, one study from the asset management arm of JP Morgan Chase noted that the S&P 500 returned an average of basically 9.2% per year for the 20-year period ending in December 2021. That's consistent with the long-term average of the stock market. You always hear it say stock market on average returns about 10%. However, in this article, it goes on to say in red, if you took it out just the 10 best days in that 20-year period, your total return would have been basically cut in half. And that's for missing 10 days over 20 years. I'm going to say that again. If you would admit, I'm going to read it again, actually, so it won't even be my words. However, if you took out just the 10 best days in that 20-year period, your total return would have fallen by nearly half. Half. 10 days.
Okay, real quick.
Yeah.
I didn't know that. I didn't know it was that stark. So it's really 10 best days over a 20-year period, not over a year.
Wow. So, you're thinking, okay, well, that sucks. we're going to go on. Let's go on. In a different study from Bank of America, looked at the stock market all the way back to the 1930s. In each decade since then, missing the 10 best days in a 10-year period cost investors huge amounts of return. And so it just says huge amounts of return. I don't know what huge amounts equates to in this, but this is coming from Bank of America and another one coming from JP Morgan. So the consistent theme is missing 10 days, missing the 10 best days is very important to your portfolio. But like Leon said, and the reason why I had my 40 and slip and just said missing 10 days, we don't know when those 10 days are going to be. No one knows when those 10 days are going to be. So let's go on. Again, we just highlighted some of this. Well, you say, I hear you all. I understand what you're saying. But I've been working with these people who time the market, and they're pretty good at timing the market. And we've been following charts, and we're looking at the floor, we're looking at resistance levels, and we know exactly when the stock is going to hit or exactly when it's going to fall through the floor. We know it. We've been doing it for 4 months, and we perfected it. So forget all this research done by these multi-billion-dollar firms. I've been doing it for 4 months, so I pretty much know what I'm doing. And if you're looking at this, or if you're listening to us right now, if you're listening to the podcast and you have questions, please let us know what your questions are. You can go to our podcast site, www.iapodcast.com. Drop a comment. We will try to respond to it as we can. If you're watching right now, you have a question. I see some things popping up in the chat. We will do our best to answer them right now. Okay, that's funny. It was just I'm actually going to show this comment. It's just a bunch of faces laughing. So all right, and this is coming from somebody on Facebook. If you all are thinking 10 days, well, I like I said, I can figure that out. Human nature doesn't work in our favor with market timing. Most people never think of selling a stock when prices are going up. With the positive reinforcement of rising portfolio values, it's easy to be a long-term investor. So you all, again, have heard Leon and I say this in different ways about different things. Leon has pointed this out with people who do options. You can have an option strategy and it's working in the right market, but when the market changes direction, that strategy can cost you to lose everything or more than what you gain in profits. Just immediately lose it. And what happens, again, you go back to human nature, and this is what I talk about a lot. There's one thing to say this is how the market works. It's another thing to say this is how human nature works. So when things are going well, everybody's like, well, I'm going to stay in the market forever. I'm never getting out. Of course, I'm a long-term investor. But as the article says, it's only when the market has already dropped that most people think about adopting timing. The danger there is that all too often, the best days in the market come on the heels of the worst days. Say that again. I'm just going to say the second part of the sentence. The danger there is that all too often, the best days in the market come on the heels of the worst days, which means when we see these precipitous drops in the market, and we're all of a sudden we're scared, and that's why the title is "Reasons Why You Shouldn't Abandon Investing when it's a rough or scary market." You don't want to pull out because you're now pulling out at the bottom, oftentimes, or close to the bottom, and you don't know when it's going to turn around. And more than likely, you're not going to believe, the emotional side of you is not going to believe that it's truly turned around until it gets somewhere past where you were in the first place, which means you just lost all that potential gain because you're watching it rise, waiting for the reality of this climb back up or past all-time highs to finally go, okay, it's ready for me to invest again. But it just experienced all of its run. And so now you're just getting back in where you're going to be in this level investment, and you're not going to see the gains that you were hoping to see. And you would have just assumed all of the loss. Understand this. You sold, watched it go down further, waited for it to go back probably to the place where you bought it, and then you're buying back in. That means that gap, you didn't experience any of that gain. None. So, I mean, really, this is, again, an article from Motley Fool. So it's not just Leon and I's words, but it goes on to give examples. How convenient. So the stock market crash of 1987 saw the Dow drop 508 points to 1,739, or roughly 23% drop, right? However, just 2 days later, the Dow jumped more than 10%, completing a 2-day rise that recovered more than half of that lost amount. If you sold on Monday during the crash, you suffered the loss but missed the gain. So that means if you panicked with everyone else, which is reasonable, if you're not naive, it's reasonable, and you do what's called panic selling, and you sold it, you're gonna watch the market until what we just said before. You feel confident enough that the market is climbing back, then you invest. You miss in this situation. If you would have done that, you would have missed 10% of recovery. You're not even still back to being whole. You would have just missed the 10% that's getting you towards whole. Why would you do that? So you say, well, 1987, the drop in the market, that was a fluke.
The stock market, that was like a generation ago. Who cares?
Yeah. Like, and let's not talk about the Great Depression in 1929. That's right. Not even going here. So we're not going to talk about that. Let's not talk about World War I or World War II. None of that is important. We're going to talk about the credit crisis of 2008, because it's in the Motley Fool article. Again, this is not Leon and I's article. We are just going through it because it echoes many of the things that we said, and we thought it'd be pretty cool if you all heard it from somebody other than us. So then the financial crisis of 2008 included a couple of instances of this phenomena. On October 9th, a drop of 679 points came just before a rebound. Listen to this. I'm going to say this slowly. An October the 9th drop of 679 points came just before a rebound of 936 points on October 13th. That was a pregnant pause, in case y'all don't know about that. So that means on October 9th, if you would have saw this drop and you freaked out and you were like, yeah, I'm definitely pulling my money out because things are going horribly wrong. Not only would you have missed the opportunity to gain all your money back, it would have also been a bonus, if you will, on top of that. Over 200 points.
And these are Dow Jones points we're talking about.
Yep.
Dow Jones.
And this is in 4 days. So please, I know some of you are thinking, oh, I would have got back in. I would have timed it right. In 4 days, you were still emotionally dealing with the fact that you pulled your money out and you want to hold it and look at it and feel secure. And again, this is a thing talking about human nature, not just what it sounds good. It sounds good to say, oh, I would have pulled out by then. I would have been fine. I doubt it. So then let's say another drop of 733 points happened on October 15th. So let's talk about the roller coaster of emotions right here. October 9th, 679 point drop. You're sitting there like, whew, I'm glad I got out before it went any further down. 4 days later, this thing climbs 936 points. And you're thinking, oh my gosh, I need to get back in. You get back in. 2 days later, there's another drop of 733 points. 2 days later. And you think, okay, you know what? I shouldn't have got in. I'm going to sell out again. So now you wrote it down twice at this point. And then it reversed on October 28th, which is 13 days later, 889 points. This is why you really don't try to time it. And this is why you have to stay the course. If you have chosen quality stocks with good fundamentals, strong leadership, is not a lot of short selling of this. Well, we're not going to go that far. So if it's a strong company, let's just say strong company. So then you're thinking, okay, you know what? I'm young. I don't know any of this stuff you're talking about. Let's go to 2020, shall we? All right. The most recent pandemic induced a bear market March 2020. Saw several wild swings. March the 9th dropped 2,014 points. Preceded a March the 10th gain of 1,167 points. Let's pause. Let's talk about what that means. That means that it gained almost 80% of the loss back in a 1 day time frame. 1 day. And this is not guessing right here. We were getting the phone calls. This is when IAA started. Mm-hmm. These phone calls were coming in and people were like, the sky's falling. We're out. And Leon and I were vehemently trying to tell people, like, just stay the course. It hurts, but let's maybe rearrange some things, but stay the course. No, run for the hills. Some people listen. So for those of you all who listen, definitely recognize you all. But this is, again, a roller coaster of emotions, because you're talking about then comes March the 12th, it dropped 2,353 points. So what about that, Brent? You're not talking about the drop of 2,353 points. Yes, I am talking about that, because the next day it recovered 1,985 points. 1,809. That's almost what, 87%? You're talking 87% the next day. And if you're a long-term investor, you're like, well, it's still not 100%. No, it's not 100%. But if it regained 87% in a day, the writing's on the wall that more than likely it's going to continue to do well. Bottom left, upper right. So those who missed that March 24th run, again, talking a few days later, 2,113 point rebound on March the 24th. That is at that point 100% recovery. Then the market was back to record highs. So if we just jump from March the 9th to March the 24th, you would not have been at record highs on March 24th, because you would have panicked on March the 9th and sold most of your portfolio, if not all of it. And then you would have said the market is fixed, or I'm jinxed, or it was never meant for me to invest because these bad things keep happening. No, the bad things are happening because we're making emotional decisions, which is reasonable to understand. Let me be very clear. It's reasonable to understand it, but we're showing you evidence. The reason why we do this research and we bring you all this information is because we get it. We're regular people too. Leon and I have emotions about the market, and we're showing you other people's words. So you're not like, well, they just keep saying this. How do we know it's true? I'm not saying Motley Fool is 100% right either, but there's a consistent theme here that shows the market oftentimes recovering. It's always recovered up until this point. Like, literally, we can say it always has recovered.
Up until this point is the non-absolute. So
yeah. And that's really the whole article right there. So for those of you all who you've been watching that with us, this is a very real thing, and this is a chart of the market with all the bad things that have happened. Bottom left, upper right. This includes. I just wanted to, just for some clarity, I wanted to read some of these things to you. This includes the stock market crash 1929. It includes the bottom of the great crash of 1932, the gold standard dropping in 1933, World War II in 1939, Pearl Harbor 1941, first nuclear chain reaction in 1942, the steel labor dispute 1952, the first U.S. Earth satellite 1958, the Bay of Pigs 1961, Cuban Missile Crisis 1962, the assassination of Kennedy 1963, Six-Day War in the Middle East 1967, Neil Armstrong on the moon, gold window closing, Arab gold embargo, President Nixon resigns. I mean, you name it, it's on here. The oil crisis in Iran, AT&T being broken apart. Like,
I mean, the more recent, the .com bust, 9/11,
9/11. I mean, they have the Gulf War, You have, I mean, it's all on here.
I mean, every crisis that through history, because I mean, we know American history is long and strong, and every crisis the market has been there. The market has gotten hit, has gotten hammered, but it has always recovered. Now, I want to make a point though. What we just showed you was an aggregate, right? So that's that's quoting the Dow Jones. The S&P was the same thing. The NASDAQ was the same thing. They all had their different numbers, but they all went down and eventually recovered. But I do want to make a point is that we're not saying don't sell when either the reason you bought a stock, it was essentially, the reason we're not saying don't sell. If the reason you bought a stock changes, that's a reason to sell, right? So like if XYZ company, maybe Amazon enters a market that your stock is in, and they're seeing their sales decimated, their CEO is indicted for whatever crime. Like if there's a fundamental change at the company that you're invested in, that is a reason to sell. When you have external factors like right now, like the pandemic, like the war in Ukraine, that have nothing to do with the fundamentals of your company. It's just the entire market is going down, so your stock is caught in the downdraft with it. To me, I think I've seen Brent too. In times like that, those are actually opportunity to buy, because as we just showed, external events that have nothing to do with the fundamentals of U.S. economy or the stock market, when the market drops, those are buying opportunities. As we showed, bottom left, upper right, every crisis has been a reason to buy stocks. Now, like I said, but again, if your company has fundamental issues, that is a reason to sell. We're not saying don't sell ever. We're saying buy quality, but quality can mess up too. They can mess up too. I mean, companies come and go all the time. So if you bought quality and then over the years earnings start to fade, their product isn't in demand, and the numbers start to drop, well, yeah, that's a reason to sell. So as we said, our 3 to 5 year rule to hold stocks, a 3 to 5 year, it's actually a guideline, not a rule. It's a guideline. But you have to be flexible and understand the market is a living beast, a living monster. It changes day to day, week to week, month to month, year to year. And right now is a huge change we're going through right now with the Fed raising rates. And then now, of course, this ridiculous war in Ukraine.
Leon, we got a couple comments and so forth that came in, so I want to address them. Monty said that he's been buying more in the top 5 companies. Top
5 what?
In his portfolio.
Oh, okay.
His top 5. And then he also mentioned that, look at the charts. Things, he said always, but I'm saying often good companies come back. I mean, because, let's call it what it is. We still have the Sears and Roebuck. And, people, Sears is the reason how many U.S. citizens learn how to read, because that catalog was one of the first widely distributed periodicals for people to read. So, I mean, Sears was a cornerstone of the U.S. being established, and it's gone. And so, I mean, when we get into the retail sector, I should say, let me say it that way. Then Mo asked, what was the question? How do we know if there's a sleeping giant in our portfolio during this environment that we should increase the size or positions of immediately? So this goes back to being parts of communities, and this is not a plug for IAA, but one of the things when all this was happening, all of you all know, I am overly weighted in Tesla. my finger was shaking. I was like, I can't take the bleeding anymore. So I had to lock in some profits. I was like, I cannot lose all my profits. But I always felt, I looked at the fundamentals and I had to check myself. Nothing had changed with the company. And when I got control of my emotions and my fingers stopped shaking, I had my brokerage account open. I had a trade screen open, and I was going to sell my position in Tesla. I just wanted to lock in my gains, and then talk myself off the wall. You have to look at the companies that you have in your portfolio, Mo. And for anybody who's listening to this, when you're looking at your companies, you're not just looking for, is it a good company, bad? Your question is sleeping giant. Sleeping giant means that it has some type of precipitous drop, but
no, he said add to. I think he means precipitous, like one that could boom.
No, he said sleeping giant. So if it's a sleeping giant, more than likely it's in. So the way the question is worded is this: how can we know if there's a sleeping giant in our portfolio during the environment that we should increase the size of a position immediately? So the way I'm reading it is essentially what in there is undervalued or right now it's taking a hit and I should be increasing my position. That's how I'm reading it.
Oh, okay. But I think the main point is when should we add to something that either is down or we think could blow up in the future. So yeah.
And so when you have a sleeping giant already in your portfolio and you're looking at it, you want to look. What I would look for, let me just change it to that. I would look for something that's had a drop of, if I say 20% or more, but fundamentally the profits are still strong. Earnings haven't changed for that company. No, there hasn't been some insiders short selling occurring. There hasn't been anything in the news that leads me to believe that the company's earnings later on are going to get hurt outside of the norm. That's important because companies have earnings. Sometimes they miss, sometimes they don't. But overall, you just seen Facebook is a clear example where this is just abnormal drops in Facebook. And I know we're on Facebook right now, but but this is one of those situations where it's like, okay, fundamentally some things have changed in this company and we need to take a second look at it. But when you look at Tesla, and I'm just using Tesla as an example because that was it for me, or PayPal. I saw PayPal is mentioned in this thread. I have no problems buying PayPal, but some people have been selling out of it. And the way we're moving towards digital purchasing and using platforms like PayPal, I don't think it's going anywhere. And PayPal's reach is so extensive. If you are an online retailer, you are allowing payments in PayPal for the most part, Square, all of them. So for that, and actually this is a good point because I held on to it. And Leon, you sold it, right?
Yeah, I sold completely out of PayPal and Facebook.
So this is one of those ones where you get to hear two opinions. Why did you sell out? I told you why I kept it.
Because I listened to the conference calls on both, and the CEO of PayPal had no answer for why growth is stagnated, and he was getting pressed by the analysts on the calls, and he was just dancing around the question, and he had no answer. So that said to me, they have no plan. They have no idea why growth has stopped or how to accelerate it. So again, for me, that's a fundamental change of the business because we're all buying these companies for them to grow. If PayPal's coming out saying now, I just want to make another quick point. So in our platform, we're having dialogue about a lot of these stocks, the ones that have come down. So I sold out of PayPal. I don't know what it's at now, but I think I took like a 10% loss on it. And Facebook, I took like a 3% loss. So they were small losses. They were relatively small losses on them. So the reason I did it, it's a fundamental reason. So it's based on the valuation. So I remember I think I owned Facebook I owned PayPal at like my breaking was like 230 something, and it had gotten down like the 170s or something. So, but I got out a little before that. I think I got out a little above 200. But basically what I'm saying is, these companies that have dropped hugely, they're down like 40 to 90%. I was even saying that on inside the membership platform that now is not a bad time to maybe take a nibble and start maybe buying some of these. I'm not going to because again, my thesis has changed. I'm mainly a growth investor. But when a stock drops that much, there and like Brent said, PayPal's not going anywhere, Facebook's not going anywhere. It's just that my break even where I got in at, it's probably not realistic that it's going to get back there anytime soon. It may or may not. I don't know. This is just the way I do it. So if I'm down, if I got into PayPal at 230 and it drops to 200, I'm out. It dropped down to 176. So that to me says my decision was good for me. But in my mind, I'm thinking it's not going to get back up to that 233 level for a while because again, most people are in PayPal for growth. They're growth stocks, right? They want to see growing earnings, growing fundamentals, growing users. PayPal said essentially we don't know what to do about growth. Like it's stalled. We have no idea what to do about it. One other quick one on that is there was a rumor they tried to buy. Well, I think it was kind of confirmed, but they tried to buy Pinterest, and all of Wall Street was like, "What the hell are y'all doing? Like this has nothing to do with your business." And what people kind of surmised was that, and this was before their earnings. What people surmised was that PayPal knew they were going to come out with a growth problem, and so they were trying to buy a potentially growth company like Pinterest to try to feed that growth. So for me, when I put all that together,
Pinterest is not a company that's winning right now.
Yeah, so. Right. Pinterest is also down like 60%. So and they also said their growth is slowing. So and actually I saw that at Pinterest too. So I say that to say I'm not saying I'm right. I'm just saying I'm right for me. Right. That's why I got out now. But I also say that these companies are down so much. If your break even, let's say PayPal is at 176 right now, my break even was 233. That's why I got out. If you can buy PayPal at 176, maybe worth a shot. Not put your whole portfolio. But like Brent said, PayPal's not going anywhere. Facebook's not going anywhere. The valuations have come down so much that this might be kind of where the natural price is now versus, Facebook was up at like 370, I think. And now it's right around 200. So it could be worth a shot. But that's the reason why the reason why I sold Facebook was because Mark Zuckerberg on the call was crying like a baby about.
Come on, about trying to get us blocked.
I know about to get kicked off the line.
Stuff you do where I end up suffering for the stuff you say.
Yeah, I'm gonna say it's like the AOL stuff back today.
Yeah, that's exactly what I was thinking. I was like, right. This dude does not think.
But these are facts. Mark Zuckerberg on the call, he mentioned TikTok like 20 times, and was basically saying how they are eating Facebook's lunch, and they have got to find a reason. They got to find a way to trump Facebook, to trump TikTok. Other reason I sold them, again, fundamentals. This is the first time in history Facebook ever had a negative user growth. So their user growth actually shrank in the most recent quarter. First time in history. So I coupled that. They're again no longer a growth company, at least in this quarter. But for me, that was enough to say thesis has changed. And they're just totally terrified of TikTok. So that's the reason why I got out of both those.
And Lee, the Facebook thing this is a really good topic to discuss. So I reduced my position in Facebook, but I didn't sell it because when I went to my portfolio, I realized I bought Facebook when it was $26.
That's right.
So
you're good. You're more than good.
Yeah, like so. But also I still reduced my position because I was like, you know what I sold pretty much locked in 300% growth. Just with what I sold, I locked in that growth, that profit margin. So keeping everything else is just I'm operating with their own money. So it's like
you're playing, as I say, you're playing with house money like at a casino right now.
Yeah, and so you gotta look at where you came in, and you have to look at also what was your philosophy about investing when you started your portfolio? Because all of a sudden, if it just goes out the window, and you're just like the market's down, so I'm selling, you probably had no strategy, and you just bought it for who knows what reason. It was popular or it seemed like a good thing to do. If you have an actual strategy, or if it's shrunk to a point where it's no longer holding 5% of its overall weighted average in my asset allocation model, then you want to get rid of it because it's not fulfilling the need that you have for that stock. Or vice versa, sometimes the position becomes too big and it overweights your portfolio. And so, it's like, all right, I need to sell some of it so I can keep my average or my weighted average in this particular stock allocation the same. So you got to have reasons versus it's bad, it's good. I don't feel good about it. I feel great about it. Move past the emotion and look at some numbers.
And most question about you have like a something that could be like a big winner, or how do you identify it? To me, like my answer to that is you can't, right? Like you don't know because we can't see the future. So you may have an idea in your mind, like, ooh, this could be the next big thing, but we never know, right? So that's why
Oh, I don't agree with that. But
you can see the future.
well, I know. So when I went to buy some of my positions, I did things that were, if you would have showed a traditional investor what I did in my portfolio, they would have told you I was crazy. Like, hands down crazy.
No, yes. I mean, yeah, we can pick things and we can go big on things and hope they pay off, and maybe they do. But again, we don't know the future. So
Yeah, you don't. It's no absolute.
Yeah, there's not. Yeah, so like Mo was saying, how do we identify something that could blow? And I'm saying we never know that, and that's why for me, I was no position in my portfolio ever exceeds 7%, and that keeps my risk management under wraps. Because if I see something like, ooh, this is going to be the next big thing, and I dump 60% of my portfolio in it, and that thing goes to zero, I am done. Like I'm dead at that point. So you never want to, and that goes back to what Brent said. That's an emotional response of like, ooh, this may blow. There's nothing in front of you that says that. It's just you're thinking that it might, but there's nothing tangible, no data behind that. Because again, we can't see the future. So, you got to have that risk management. You got to keep your sizes small relative to your portfolio. And if something does start to move up, maybe add to it, dollar cost average into it as it's rising, but never, jump all in like this is going to be next big thing. That's a way to just, blow your account.
Yeah, but I do that. So
yes, Brent does it. Yes. So far he's done well. But one last point. You notice what I said. I took a loss on PayPal and I took a loss on Facebook. Right? I think it was 3% on Facebook and like 10% on PayPal. Losses happen, right? Like they are real. Brent and I take them all the time. When the stock we sell, goes against our thesis now, you got to move on. We're not investors, and we try to preach this, like, don't be about that world, like
day trading.
So I would say I'm in this game to make money, not to be right? So I'm an investor to make money, not to be right. Meaning, if I'm wrong about a stock, I'm wrong. I cut my losses I try to keep it under 5%. Well, yeah, I try to keep it under 5 to 10%, and then I move on. But I don't want people think that to mean that if a stock drops like 8%, I'm immediately get out. No, because I have to understand the fundamentals of the company, what's going on with it. If everything is fine, I'm gonna stay in it. If my thesis changes, then I will. But basically what I'm saying is losses are gonna happen. We take them. We're not out here trying to say that everything we pick is right. No, that's not true at all. So losses are not a bad thing. And the main thing is you want to cut your losses small. When that thesis changes, get out. Like don't wait around like I hope it comes back. I feel like it will. Get that emotion out of it and just cut your losses.
And look at what the company's doing. Again, go back to the numbers. And we showed, if you're a member by A, we showed you how to do research. We showed you where you can look. It was one company that I've shown. If you saw the hot seat where I was in it, you saw a stock that went to zero. I owned it. It went to zero. And the thing is, I didn't check, and I did. I had that mentality. Oh, it'll come back. Oh, it just needs enough time. And I wasn't being as disciplined as I could be. And I'd let it just sit there, and it just went lower and lower and lower. And honestly, it got to a point where I was just curious if it can go to zero. I had never owned a stock that went to zero. So I held it just to see if it would go to zero at that point. I was like, I just want to see if it happens because I wanted to say I've experienced it all. And it went to zero. So I can say I've experienced a whole lot because there's a lot more out there. But
sorry, go ahead.
Yeah, initially, I just was emotional. Mm-hmm. Initially, it was purely me hoping that it would come back. And then after I stopped hoping, then it became just I don't want to be this wrong. And then it became fear of like, well, I can't take this kind of a loss. I have to get it. I have to wait for it to get back to a place where I feel like I made the right decision. And that's so I really respect what Leon just said. And I think all of you all should listen to that. It's about making money in this market. It is not about being right. And Leon, we need to give a quick shout out to Antonio, who brought us into the
definitely
Minority Money Matters conference. I think it was sponsored by the Anne Arundel chapter, the NAACP. We spoke Saturday for them. So thank you. That was amazing.
Definitely. Mm-hmm.
We got a lot of great responses from that, and the feedback was really, it touched us. But just wanted to give you a quick shout. And then Mo also said, I'm basically talking about the company that is super solid. That's what. So a company is super solid, down 20 to 40%, but fundamentally the company is sound. The correction is steep, but likely recovers quickly. Yes, and that's what I was alluding to when I was saying if it's down like 20, 30%, and nothing has changed fundamentally, and this is important, the projections for the future look promising. Even if a company projects like windfall of new business, there's no guarantee for that. Zero. And one of the things that we talked about earlier was work. What was it? Workhorse. What was that? EV.
Oh, that auto, the EV company. I think it was Workers.
I think it was Workhorse. And so let me bring this up because this is a great example of hope. They made these announcements and projections on this $90 million contract that was coming in, and that was pretty much going to float their whole company for the next like 3 years or so.
And it was going to be with the U.S. Postal Service.
Yeah. And then the contract didn't happen. This company had like an 80% drop like the next day. And this was specifically a company Leon and I warned everybody not to buy. But if you looked at it and you were looking at just projections or what they were saying in the news, you might have thought this company has a real chance. It had no fundamentals. It was highly leveraged. And as we know, in this environment, inflationary environment, highly leveraged companies will lose. So,
yep.
That's
it. Yeah, that's a good example of why it's always about the numbers. What companies say. Now, what companies will give what they call guidance after their earnings, and they'll basically tell you what they project their earnings, sales, profits to be in the next quarter or the next year. That's something you weigh, something you take in, and also analysts like J.P. Morgan, Bank of America, their analysts will do the same thing. Basically, what you're looking for kind of like a consensus that things are going up. Like, Bank of America has the projections being down, the company has the projections being up. It's a bit of a red flag. You may want to tread a little lightly on that one. But projections are, like Brent said, there's no guarantee with them. That's why I always bank on what's happened in the recent past, the recent like 3 years, 3 quarters of revenue and sales. That's what I use. But yeah, yes. News headlines are nothing to invest off of.
Yeah, and so we're gonna leave with this one thing again. If you look at this, pulling it back up, and I'm just reading this one sentence. So if you listen to the podcast, I pulled up the Motley Fool article, and I am reading one sentence. The danger there is too often the best days in the market come on the heels of the worst days. So I'm gonna read just a part of that now. The best days in the market come on the heels of the worst days. Actually, we're gonna get that on the t-shirt. It is very real. You have to be able to weather the storm. And the only way you really can weather the storm is if you have done something that we've talked about since we started IEA. You're using risk capital, you're using curious money, you're using dry powder. You are not using your kids' daycare money, your mortgage money. You're leveraging your house in order to get into the market because you got the hot thing. You're not borrowing money from friends and family because if you put in this short position, this company is going to drop and you're going to make a killing, and all of a sudden it doesn't, and you owe all these people money, and you're trying to figure out what happened. You aren't trading on margin because you think it's cool, and you have no idea what margin really means, and you get a margin call, and all of a sudden you're freaking out. You're not trying to do day trading thinking you figured out the algorithm that clearly no one in the world knows because you met one person on YouTube that slid across the hood of a Ferrari and told you this is going to work for you because it worked for them. Those are things you just don't do in the market. Leon, you got anything before we go?
Yeah, stay long term. Like I said, we've been highlighting inside the membership area that time in the market beats trying to time the market every time. The market goes up over time. The studies have shown there's a correlation between positive returns and time in the market. Meaning, the longer you're in the market, the better your probabilities of making money. The shorter you're in the market, the less time you're in the market, the less your probabilities are of making money. So, and like Brent said, main point, 10 days, just 10 days. So everybody out here that's trying to time it, I'm gonna get in here, I'm gonna get in there. No, if you have the money at that moment in time and you can spare it, buy that day, and then do it again the next month, and then do it again the next month. Don't try to figure out when, where, how. Just get in if you believe in the company, you've done your research, and something you want to invest in.
Yeah, and everybody who's listening to this, watching us live, you have a gift that Leon and I did not have when we started investing. Fractional shares. Right. When we first started, it was either you buy the whole thing or none at all. And so for all of you all who are thinking, so many stocks cost too much, you have fractional shares. It's basically like you can decide on a day that the company has a stock split.
Right. Nope. Hey, bro, real quick. So is that a question or a comment on the screen?
It was a comment. Sometimes those projections include a reinvestment of capital into the company that may allow potential long-term growth. It may mean profits aren't as high as in the short term, though. So
yes, hey, so I say real quick that's a good point today. So anybody that owns Snowflake, you felt some pain today. I own Snowflake.
You own Snowflake?
Yeah. I kept Snowflake's one of the ones that I kept. Mm-hmm. Yeah,
I sold one position.
You sold it? Okay. Sorry, and it wasn't even Snowflake. Well, just real quick, Snowflake today reported their earnings. They were awesome. They were great through the roof. But Wall Street was expecting a higher revenue growth. I think they were expecting like 100 something. The revenue growth next quarter, I think, is going to be like 80%. So the stock took a big hit. But that just sold FYI on that. My other one thing about was Okta. OAKT or so.
KTA. OKTA.
OKT. Yeah, I think OKTA. So I used to own them. I sold them a while ago. Reason being is because their growth wasn't as high as it was in the past. So, again, sold it for that reason. But to this point, so the CEO today was on CNBC, and or he was on Jim Cramer's show, and Cramer was like, your revenue growth looking great, but he was like, when are you going to make money? Because like in this environment, if you're not making money, you're going to get hit. He said exactly what this comment says, that he made the point that any money they make right now, they're plowing back into the company. So they're doing what Amazon did back like 20 years ago. Amazon back in the day was making money they could have been making money hand over fist, but at the time they were like, we're going to plow the money back into the business to grow the business. And now we see what Amazon is today, right? So Okta is taking the same sort of plan. They're saying, right, we're going to take the short-term losses for the long-term gain, which is fine, but Wall Street doesn't care right now. Wall Street is saying, if you're not making money, you're going to get hit. So while that's good for the company, and Okta may be a good long-term buy, I don't know. But in the short term, when I'm looking at my money right now, that thing was getting hammered. So I sold out of it kind of when this whole Fed thing started. But that just bring back to that point that, yes, if companies are investing their profits now, there won't be any profits to show. It won't look like there's any growth, but they're actually reinvesting the company for future growth. So it's something else to weigh. It's kind of a fundamental thing if you wanted to. But right now the market is punishing any company that's not making any money.
Yeah. So with that being said, we hope you all take this message, apply it to how you're investing, really apply it to your emotional state, because right now, it's a lot of people very emotional about the market. It's all over the place. We're riding that wave with you all. We're not impervious to it. No one is. If anyone says they are, it's not true. And so if you have questions, you can find us. If you're looking for that article that I was just reading through, if you're in the IAA community, it is actually listed in the intermediate stock section inside of our platform. So you can go, you can read it. A number of you all have already read it and drop comments about it. So we owe you two things, 2 stock picks or cryptocurrency. Mm-hmm. We are going to put one inside of the Investing Education Academy Facebook group. The other we will put into the membership platform. So you should see it, if not in a couple hours, tomorrow. Thank you for being with us. Leon, do you have anything before we go?
Nope. Just keep like I said today in the platform earlier, just keep your focus on profitable companies. And right now in this environment, big brand names that that you use every day that are profitable. Those are the ones that are most likely to ride through this storm until we get on the other side of this whole Fed war thing.
Yep. Everybody, thank you.
Real quick. That was last thing. The Fed. Last point. So this is very important. So today, the Federal Reserve Chairman testified on Capitol Hill. He said so. There was a debate in the market whether they were going to raise by 50 basis points or 25 basis points. The reason that's important is because if they raise it by 50 basis points, that makes bonds more attractive to big money because rates are going to be going faster. And remember, the rates that the bonds that the treasury bonds by the U.S. government are essentially guaranteed, right? They're backed by the U.S. government, so it's almost like guaranteed money. So if rates and those assets go up fast, big money's going to pull their money out of the stock market and go plow it into bonds. So a 50 basis point raise was scary to stock investors because we were like, if they do that, a lot of money's going to say, oh, I'm going to go chase that guaranteed return versus being these risky stocks.
And Leon,
the Federal Reserve,
real quick, 50 basis points for anybody watching is equal to 0.5%.
Right. Yeah. So yes.
You say basis points, it's probably like basis points.
Yeah. 0.5% of 1%. Right. But Jerome Powell came out today and said they're only going to do 25% or 25 basis point raise, which the market cheered, loved, was woohoo. And you saw today the market was up about 1.5% because the stock market was like, yes, we got that off our back. There's no 50 basis point raise. There's not going to be a bunch of money pulled out of the market going into bonds. So that's just FYI where the Fed stand. March 16th is their next meeting, and that's the day that rates will be raised. So Jerome Powell is saying right now, 25 basis points.
All right. So there you have it, everybody. A little bit of news on top of it all. So enjoy the rest of your Wednesday. Enjoy the rest of your week. For anybody who's in IEA, we will see you this Saturday for Ask an Expert, where we have an expert come on to our live platform and you get to ask them as many questions as they can answer in an hour. So have a great day.